The headlines arrived with predictable urgency. Silver crashes 6%. Gold tumbles from historic highs. Bullion bubble bursts. Precious metals peak reached. The financial media, which largely ignored the months of steady appreciation, discovered precious metals the moment they declined. The coverage that was absent during the rise became saturated during the fall. This pattern is not new, it is not accidental, and understanding it matters more than understanding the price movement itself. A 6% decline in silver. A 3% decline in gold. These are the numbers. They are real. They appear on screens and in portfolios. But numbers without context are noise. And noise, amplified by media with incentives misaligned with understanding, becomes confusion. This is not analysis that will tell you whether the decline continues or reverses. That question cannot be answered honestly by anyone. Markets move where they move, indifferent to prediction. This is analysis that places the decline in context. Historical context, structural context, psychological context. The context does not make the decline disappear. It does not transform loss into gain. It does not provide comfort to those who bought at higher prices. What context provides is understanding. And understanding, over time, horizons that matter, is more valuable than prediction. The first context is historical. Every significant precious metals advance in modern history has included corrections of similar or greater magnitude. Not one exception exists. The 1970s gold bull market, the most famous precious metals advance of the 20th century, took gold from $35 to $850, a 24-fold increase over a decade. Within that advance, corrections of 15%, 20%, 25% occurred repeatedly. In 1974, gold fell from $195 to $103, a 47% decline. Headlines declared the gold bubble over. The advance had ended. Sanity had returned. Gold then rose to $850 over the following 6 years. In 1975 and 1976, gold traded sideways to down for nearly 2 years. Patience was tested. Conviction was questioned. Many who had bought during the initial rise sold during the consolidation. They sold before the majority of the advance occurred. The pattern repeated in the 2000s. Gold began a new advance in 2001, rising from $250. By 2008, it had reached $1,000, a four-fold increase. Then the financial crisis hit. Gold fell from $1,000 to $700 in a matter of weeks. A 30% decline during a financial panic when gold was supposedly the safe haven. Headlines declared that gold had failed. The safe haven narrative was broken. The bull market was over. Gold then rose to $1,900 over the following 3 years. Silver's history is even more volatile. In the 2010-2011 advance, silver rose from $18 to nearly $50. Along the way, corrections of 15%, 20%, and more occurred multiple times. In early 2011, silver fell from $49 to $33 in a matter of days, a 33% correction. The silver bubble had burst. The speculative excess had been purged. Silver then recovered to $48 within weeks before the final peak. The historical record is unambiguous. Corrections are not evidence that advances have ended. Corrections are features of advances, the mechanism through which weak holders are transferred to strong holders, through which sentiment is reset, through which the next leg is prepared. This does not mean every correction is followed by new highs. Sometimes corrections are the beginning of bear markets. The 2011 peak in silver was followed by a decade of lower prices. But the existence of a correction does not distinguish between these outcomes. Corrections occur in both continuing advances and ending advances. The correction itself provides no information about which type it is. The second context is structural. The conditions that have driven precious metals higher have not changed because prices declined for a day, a week, or a month. Global debt levels remain at historic highs. Government deficits remain structurally elevated. Central bank balance sheets remain expanded beyond any historical precedent. The monetary system remains under the same stresses that existed before the correction. The debasement of currencies continues at the same pace. The confidence that underpins paper assets remains as fragile as it was at higher prices. A 6% decline in silver does not reduce global debt. It does not balance government budgets. It does not shrink central bank balance sheets. It does not restore confidence in monetary institutions. The decline changes nothing fundamental. It changes only the price at which the unchanged fundamentals are reflected. This distinction matters enormously. If precious metals rose because of a speculative mania, because of momentum chasing, because of greater fool dynamics, because of narratives disconnected from reality, then a correction might signal the end of the mania. But if precious metals rose because of structural conditions in the monetary system, because of debt levels, because of currency debasement, because of declining confidence in paper promises, then a correction does not address those conditions. The conditions persist. The prices fluctuate. The relationship between the two is real but not linear. Prices overshoot in both directions. They rise beyond what conditions justify and fall beyond what conditions justify. The fluctuations around the trend are larger than most participants expect, but the trend, the direction driven by structural conditions, does not reverse because of a 6% decline. The trend reverses when conditions change, when debt is reduced, when deficits are closed, when central banks normalize, when confidence is restored. None of these conditions change this week. The third context is psychological. Corrections serve a function in market psychology that is distinct from their function in price discovery. Corrections shake confidence. They cause participants to question their positions. They create doubt where certainty existed. This psychological function is why corrections occur, not as random noise, but as necessary mechanism. Markets cannot rise indefinitely without corrections. The absence of corrections creates fragility. Too many participants, holding positions, with too little conviction, ready to sell at the first sign of trouble. Corrections purge this fragility. They force the uncertain to sell. They transfer positions from those who doubt to those who do not. This transfer is not gentle. It is not pleasant. It involves loss for those who exit and requires conviction from those who remain. But the transfer is necessary for sustainable advances. A market where everyone holds with conviction is more stable than a market where everyone holds with uncertainty. The media coverage of corrections amplifies the psychological effect. The headlines that declare bubbles burst and peaks reached are not neutral observation. They are participation in the psychological mechanism. They provide justification for selling. They create social proof that selling is the correct response. The absence of similar coverage during advances is equally non-neutral. It allows advances to proceed without the psychological headwind that coverage would create. This asymmetry, aggressive coverage of declines, muted coverage of advances, is structural in financial media. It reflects incentives, audience psychology, and the business model of attention capture. Understanding this asymmetry does not make it disappear, but understanding it provides distance, the ability to observe the mechanism rather than be subject to it. The question is not whether the headlines affect psychology. They do. The question is whether understanding the mechanism allows response rather than reaction. The fourth context is the distinction between price and signal. Prices move. This is what prices do. They move up and they move down. The movement is continuous, often violent, rarely comfortable. Signals are different. Signals are the information content embedded in prices and in the conditions that prices reflect. A price decline is a price decline. It is a number that changed from a higher number to a lower number. A signal is what that change means, what information it conveys about conditions, about participants, about the future. The conflation of price and signal is the source of much confusion in financial markets. When silver declines 6%, the price has changed. But what signal has been sent? One interpretation, the signal is that the advance has ended. The buyers are exhausted, the sellers have gained control, the trend has reversed. Another interpretation, the signal is that a correction is underway within a continuing advance. Weak holders are being shaken out. Strong holders are accumulating. The trend remains intact. A third interpretation, there is no signal. The movement is noise, random fluctuation around a trend that continues regardless of daily or weekly movements. The price itself does not distinguish between these interpretations. The price is just a number. The interpretation is a judgment about what the number means. This is why price watching is treacherous. It provides data without providing interpretation. It shows movement without showing meaning. The structural conditions provide meaning that price alone cannot provide. If conditions have changed, if debt has declined, if confidence has been restored, if monetary policy has normalized, then the price decline might signal trend reversal. If conditions have not changed, if debt remains elevated, if confidence remains fragile, if monetary policy remains accommodative, then the price decline is more likely correction than reversal. The conditions are observable. They can be examined independently of price. They provide context that price alone lacks. This does not eliminate uncertainty. Conditions are not perfectly correlated with prices. Timing is always unknown. But conditions provide a framework for interpretation that price watching alone cannot provide. The fifth context is the mechanics of corrections. Corrections do not occur randomly. They occur through specific mechanisms that can be understood even when they cannot be predicted. Leverage is the primary mechanism. When prices rise, participants who use leverage accumulate profits. Their positions become larger as gains compound. The leverage that amplified gains on the way up becomes a vulnerability. When prices decline, leverage amplifies losses. Participants face margin calls, demands for additional capital to maintain positions. Those who cannot meet the calls are forced to sell. Forced selling creates more price decline. More decline creates more margin calls. More margin calls create more forced selling. This feedback loop, the liquidation cascade, is how corrections become violent. It is not belief or analysis driving the selling. It is mechanical requirement. The 6% decline in silver almost certainly involved liquidation of leveraged positions. The speed and magnitude suggest forced selling rather than considered selling. This mechanical nature is important for interpretation. Forced selling is not informed selling. It does not reflect analysis or conviction. It reflects insufficient capital to maintain leverage. When forced selling exhausts itself, when the leverage positions have been liquidated, the mechanical pressure ends. What remains is underlying supply and demand from participants who are not leveraged, who are not forced to sell. This underlying balance determines what happens after the liquidation cascade ends. If underlying demand exceeds underlying supply, prices recover. The correction was a leveraged shakeout within a continuing advance. If underlying supply exceeds underlying demand, prices continue lower. The correction was the beginning of a larger decline. The correction itself does not reveal which dynamic is operative. Only time and subsequent price action reveal it. But understanding that corrections often involve mechanical liquidation rather than informed judgment provides perspective. The violence of the correction does not necessarily reflect the conviction of sellers. It may reflect only the mathematics of leverage. The sixth context is the narrative competition. There are always two narratives available during a correction. The first narrative is the bear narrative. The advance was speculation. The prices were unjustified. The decline is the market recognizing reality. The trend has reversed. Those who hold are denying the obvious. The second narrative is the bull narrative. The advance reflected fundamentals. The prices were justified or even understated. The decline is temporary. The trend remains intact. Those who sell are making a mistake. Both narratives are available at every correction. Both have adherents who argue passionately. Both can be supported with selective evidence. The competition between narratives is not resolved by argument. It is resolved by subsequent price action. One narrative proves correct and the other proves incorrect. But the resolution takes time. Weeks, months, sometimes years. During the correction itself, both narratives coexist. The uncertainty is genuine. The correct interpretation is not knowable in real time. This uncertainty is uncomfortable. Humans prefer certainty. The temptation to adopt one narrative with conviction, to eliminate the discomfort of uncertainty, is powerful. But adopting narrative conviction does not eliminate uncertainty. It only conceals it. The future remains unknown, regardless of how certain the narrative feels. The alternative to narrative conviction is structural observation. Rather than adopting a narrative about what the correction means, one can observe the structural conditions and note whether they have changed. If conditions have changed, the bear narrative becomes more probable. If conditions have not changed, the bull narrative becomes more probable. This is not certainty. Conditions and prices are not perfectly correlated, but it is a framework that does not require pretending to know what cannot be known. The seventh context is the function of precious metals in a portfolio. For those holding precious metals as speculation, as a bet on price appreciation, corrections are threatening. The bet may be wrong, the loss may be permanent, the position may need to be reconsidered. For those holding precious metals as insurance, as protection against monetary system failure, corrections are different in character. Insurance is not evaluated by its daily price movement. Homeowners insurance is not considered a failure because it did not pay out this month. The value of insurance is in the protection it provides against catastrophic events, not in its daily market value. Precious metals held as monetary insurance serve a similar function. They provide protection against scenarios where paper assets fail, where currencies devalue dramatically, where banking systems freeze, where the promises embedded in financial assets are not honored. These scenarios are not everyday scenarios. They are tail risks. Low probability but high consequence. The value of insurance against tail risks is not measured by daily price movements. It is measured by whether the insurance will perform when needed. A 6% decline in silver does not change whether physical silver will hold value if the banking system fails. It does not change whether gold will be accepted as payment if currencies hyperinflate. It does not change whether precious metals will provide purchasing power if paper assets become worthless. The insurance function is unchanged. Only the daily valuation of the insurance has changed. This distinction requires genuine clarity about why precious metals are held. If they are held for speculation, the correction matters greatly. The speculative thesis is being tested. If they are held for insurance, the correction matters less. The insurance function is not being tested by price movement. It will be tested only by monetary system performance. Most participants hold precious metals for reasons that blur this distinction. They want insurance, but they also want appreciation. They want protection, but they also want profit. This blurring creates psychological vulnerability during corrections. The speculative desire for appreciation is threatened while the insurance function is unchanged. The dissonance is uncomfortable. Clarity about purpose reduces the dissonance. It allows evaluation appropriate to the actual function being served. The eighth context is what corrections do not reveal. Corrections do not reveal whether the fundamental case for precious metals is correct or incorrect. The fundamental case rests on conditions in the monetary system: debt levels, currency creation, confidence in institutions. These conditions exist independently of precious metals prices. They can be evaluated independently of price movements. A correction does not prove that debt levels are sustainable. It does not prove that currency creation is benign. It does not prove that confidence in institutions is warranted. The correction proves only that prices declined. The reasons for the decline, the mechanistic and psychological factors discussed above, are distinct from the validity of the fundamental case. This is why price watching is insufficient for understanding. Prices reflect many factors simultaneously: fundamentals, psychology, leverage, positioning, flows. Disentangling these factors from price movement alone is impossible. Fundamentals can be evaluated independently. Psychology can be observed, leverage can be estimated, but the interaction of these factors in producing a specific price movement cannot be precisely decomposed. The correction is a data point. It is not a verdict. Those who interpret corrections as verdicts, as proof that the bull case was wrong, are reading more into price movement than price movement can convey. Those who ignore corrections entirely, who dismiss price movement as irrelevant noise, are reading too little into information that does have content. The appropriate response is neither to treat the correction as verdict nor to dismiss it as noise. The appropriate response is to place it in context, to understand what it does and does not reveal. What it reveals: prices can decline, leverage creates volatility, psychology shifts, narratives compete. What it does not reveal: whether fundamental conditions have changed, whether the advance is over, whether holding or selling is the correct response. The asymmetry between what is revealed and what is not revealed is important. It defines the boundary of what can be known from price observation. The question posed by the headline, "Has the bullion market peaked?" cannot be answered honestly. It cannot be answered because the future is unknown. It cannot be answered because the conditions that would determine the answer have not yet manifested. It cannot be answered because the question itself assumes predictability that does not exist. What can be answered is a different question. Have the conditions that drove the advance changed? Debt levels, unchanged. Global debt remains at historic highs relative to GDP. Government deficits remain structurally elevated. The trajectory is toward more debt, not less. Monetary policy, unchanged. Central banks remain constrained between inflation and financial stability. Balance sheets remain expanded. The capacity to normalize without crisis remains absent. Confidence, difficult to measure, but observable indicators have not shifted. Demand for physical precious metals remains robust. Central bank gold purchases continue. The behaviors that reflect confidence erosion have not reversed. These conditions were present before the correction. They remain present after the correction. This does not prove that prices will recover. Prices and conditions are correlated but not identical. Prices can diverge from conditions for extended periods. But it suggests that the correction is more likely a fluctuation within a continuing environment than a signal that the environment has changed. This interpretation could be wrong. Every interpretation could be wrong. The humility to acknowledge uncertainty is essential. But an interpretation grounded in structural observation is more reliable than an interpretation grounded in price movement alone. Gold does not rise, confidence falls, silver does not spike, systems strain. And gold does not peak because it declined 3%. Silver does not crash because it fell 6%. The words we use to describe price movements carry implications beyond the movements themselves. Crash implies ending, peak implies reversal, tumble implies loss of control. These words are chosen for effect, not accuracy. A 6% decline is a 6% decline. Whether it represents a crash, a correction, a fluctuation, or the beginning of something larger cannot be determined from the decline itself. The context determines the meaning. The conditions determine the implications. The structural observation determines the interpretation. And the structural observation, as of this moment, suggests that the conditions driving precious metals higher remain in place. The monetary system remains under stress. The currencies remain being debased. The confidence remains fragile. The fundamental case remains intact. The price has declined. The case has not. For those who distinguish between the two, for those who observe conditions rather than merely prices, for those who understand that corrections are features, not failures, the decline is information. It is not verdict. What is done with that information is individual judgment. But the judgment should be informed by context, not headlines. The context is what this examination has provided. The judgment remains yours.